In this episode of the Fintech Files, I'm delighted to speak to Nicolas Rabener, the founder of FactorResearch. We're going to investigate into the world of quantitative investing and factors. Nicolas, welcome to the Fintech Files.
Thanks for having me.
So what is factor investing and why is it important?
Investing is simply rules-based investing. And why is it important? It's quite simple. It explains the outperformance of active managers, or most of it at least. So if you go back in time, 20, 30 years ago, you had a fund manager that, for example, beat the FTSE 100. You said, great job, well done, we'll give you more money, and next year you'll do the same. Nowadays, because of better technology and data, effectively the investors in a fund manager have the ability to analyze the track record, and most of it can simply be explained by these rules-based investing frameworks. It might be that the fund manager is buying small companies from a market capitalization perspective. It might be buying that he's cheap companies, but effectively we can explain it. And once we can explain it, we can replicate it, and usually replicate it at low cost. And that effectively has shown that what mostly active management is doing, in a sense of when it is achieving outperformance, that there's a lot less magic to it, there's a lot less alpha, to be precise, than 20 or 30 years ago investors assumed. And that's why factor investing has become popular, simply because it allows to differentiate between truly unexplained returns, which are alpha, or indeed the fund manager is doing something unique, which is difficult to explain, versus simply following rules-based frameworks that can be replicated.
Understood. And now, if I look, for example, at your Factor Olympics, which is something that you publish every year, what I've read there, and the first thing I noticed is that when we talk about different factors, such as you'll tell us value or size, which is the smaller capitalization, we're always talking about long and short. Can you explain that?
Sure. So if you look at factor investing, it's effectively based on a lot of research, for example, by professors like Farmer and French and so on, that also publish data that anyone can download on the internet. They analyze factors themselves. It's a great and free resource. And all of that research, or most of it, is based on effectively on long-short portfolios, which effectively means that these return a series that they are net of the market. So when you look at the value factor, for example, it means you buy the cheap companies and you short the expensive companies. Now, when you look at those return stream over time, the performance effectively, you can quite clearly see if it's going up or down, right? If that factor would allow an investor to generate excess returns or not. That's from the academic perspective, and effectively most academic research is based on long-short portfolios, just to clean. Having said that, in reality, from a money perspective, most of it is invested in long-only factor investing strategies, which effectively is smart beta. So most investors, they don't tend to invest in the long-short portfolios, either because they're not available or more for behavioral reasons. And so if you look at, for example, in terms of smart beta, there's about 800 billion invested in smart beta ETFs, which is long-only factor investing, so just buying cheap stocks or overweighting them, to be precise, and underweighting expensive ones. Versus if you look at, for example, from an ETF perspective, in terms of long-short factor portfolios, it's less than 3 billion, so a tiny percentage. So there seems to be a gigantic discrepancy between what investors read, which is the academic literature, which is all long-short, and what they're practically investing in.
If I look again at what we hear in the news, one of the things that seem to be a factor is growth. And I don't see it appearing in your Factor Olympics.
That is correct.
Did you read that?
Growth is the unusual one, because again, if you look at simply from assets under management, for example, in smart beta ETFs, there is, as of today, there's more money in growth smart beta ETFs than in value smart beta ETFs. And it's funny because if you look at the academic literature, there's hardly any research that highlights that growth as a strategy generates excess returns. And you can also argue that partially growth is the inverse of, for example, value, because value tends to be companies that are cheap, at least from a long-only perspective. These are companies in trouble that usually have very low growth rates, versus if you think about a growth strategy, you think about the technology stocks, and they tend to have very high growth rates, at least from a revenue perspective, not necessarily from a profit perspective. And so there is this discrepancy in the sense of between academic literature, which effectively says growth is it is a factor, because a factor is any rules-based, but it's not a factor that is supported in terms of generating excess returns. Versus on the practical side, where a lot of investors like growth investing style because it sounds great to invest in an Amazon and an Apple, companies that have great growth rates, even for them. But it is a bit unusual. And from our perspective, we also make the comparison of this being Dr. Hyde and Mr. Jekyll, that when someone reads about factor investing, they read all the literature that has nothing on growth, and then what they do in reality is the inverse. And so I think that's just one of those things in financial markets that makes them interesting, that investors are perhaps not rational, that they tend to do things that are perhaps not backed by research, even through the reading it, and from a theoretical perspective should avoid growth at all costs.
Yeah, that's a really interesting and striking perspective to think about how also what is packaged as something research-driven is in fact quite far away from research. And may I ask as well, if we stay in this, let's say, theoretical or research-based environment, if in theory it's long-short, so would we say factor is mainly an alternative investment? Would that belong to that space?
Depends how you structure it from a product perspective. So if you think about factor investing, as mentioned, there's nothing new about it. People have been, or fund managers have been buying cheap stocks for decades. No, it's the only thing that factor investing has perhaps brought out, that it indeed can be more systemized, that it can be put into rules-based products. But the styles per se, like being a small cap fund manager or being a value-driven fund manager, nothing about that is new. Investors have been doing that for forever, effectively, since the inception of the stock markets. And so when you then think about the long-short versions of that, I would call it more, or I think not me personally, but more the industry, it's more what is considered alternative beta. So effectively, if you think about it from a pyramid perspective, at the bottom of the pyramid, you simply have market beta. And that might be the exposure to the stock market, might be the exposure to the bond market. On top of that, you have what might be called alternative beta, and that's exposure to factors. So within stocks, for example, I can overweight the small caps, I can overweight the cheap stocks, and so on. And on the top of the pyramid is alpha. So that's the unexplained returns. And that, of course, is the holy grail that everyone wants to get, but that is proving exceedingly difficult to find because, as mentioned, unfortunately, most of the excess returns or the outperformance is explained by factors. And even if you find alpha in a fund manager, and it doesn't matter if it's long only or long short, right? You can measure it both ways. Then often the issue is that it's not consistent. So once you identify it, doesn't mean that investor is able to reproduce it on a going forward basis. But so factors from our perspective, for example, if you structure it as a long short product, I wouldn't call it as a classic alternative product. It's more like alternative beta product. And that is also something that from an investment industry perspective, I think, for example, all the investment banks that are selling long short risk premium indices, that exactly represents that, right? Everyone has realized those factors exist for a variety of reasons, and they're being packaged and offered to investors to simply get effectively what they see in research and hopefully offers excess returns as well as diversification to portfolios.
That's also an interesting perspective in terms of, let's say, traditional versus alternative investing. It's not one over the other. It seems like you describe something which is more like a gradual evolution toward, or different solutions for investors from more traditional or more beta and trying to get more alpha, and we're going to get there later.
Yeah, correct. The basic of that is simply because data is becoming better and technology is becoming better. So nowadays it's quite simple. You can go to any data provider or even ourselves and find out, does a certain portfolio, a certain fund manager, does he have alpha? If you think back 20 years, it was a much more difficult exercise versus today you have more than 3 million indices. So you can dissect a fund manager's performance very finely and find out, is there really something unexplained that fund manager is doing? Or is it simply something out of alternative beta space or some sort of market exposure that just wasn't measurable before? And of course, going forward, I think from an industry perspective, this will become even tougher, right? Because data will continue to improve, technology will continue to improve. So I think the power partially is shifting from the fund managers to the allocators as they effectively are being empowered by data and technology.
We should go further into that, but before that, I would like to stay and understand how is this built. So how do you create factor indices? What kind of data and tools do you use?
Sure. So within our firm, we create indices from scratch, but we also use external ones from outside providers. And so a very simple example, let's say we talk about the value factor. Effectively what you want to do there is you take all the stocks in a certain universe, for example in the US, above a certain, let's say, market cap, about, let's say, $1 billion, and then effectively you rank them. And when we talk about the value factor, we're talking about cheap and expensive companies. So then it already starts getting a little bit complicated because you can think about how do I evaluate if a company is cheap or expensive? I could look at price to book, I could look at EV/EBITDA, I could look at price to sales, you could use a multi-metric approach. But let's say we define cheapness simply by price to book, so we rank all the stocks. And the next question is, how do we create portfolios? So you say, fine, let's say the top 10% of the cheapest stock or the cheapest stocks, that's effectively my long portfolio, and the 10% of the most expensive stocks, that's my short portfolio. And if I do that on a daily basis, then effectively I get the return stream of the value factor on an ongoing basis. And you can do that, of course, going back historically, which is quite data intensive, because what that requires is not only to have the stocks as of today, but also the stocks that didn't survive. So you've got to be very careful with an index construction. That's where the complexity comes in, and where data requirements are quite high, in the sense of really reflecting that universe over time has changed. Companies merged or spun off, companies went into bankruptcy. And that effectively reflects an as true as possible performance of how value would have performed over time. Another thought there is, for example, should we include or exclude transaction costs? Because portfolio should be rebalanced on a regular basis, right? Might be on a monthly basis or quarterly basis, because some of those cheap stocks might have revived, might have become more expensive, versus some of those expensive stocks might have become cheaper. And so as you can see, in terms of creating even a factor portfolio on one day has already quite a lot of assumptions that need to be made. And then if you want to do that in terms of creating a factor index going back over time, it becomes much more complex. And effectively what you need to do is you need to code this. So you need a database that has all the historic prices as well as fundamentals, depending on which factor you're talking about. And then you need to code in terms of that you have a daily NAV calculation over time that creates you what you want ultimately, which is that return stream, that time series over time. And once you have that, then you can think about that, how has it performed and what's impacting that, and work with the data going forward.
And could there be some skills? We said it's all rules-based, but could there be some skills in defining those rules and defining the data? So for example, if we take as value, you said one simple way to say it is price to book value, but you could do it more sophisticated. And perhaps if I'm a very sophisticated investor, I've got my own definition of value, and I also look at the accounting and normalize it or do things like that. Could that be, let's say, still looking at factors and rules-based, but really having skills, applying some skills?
I think that's depends who you ask. So from our perspective, there is somewhat an AQR, which is a very well-known punch shop. They published a fantastic paper on that called, I think, craftsmanship. So indeed, I think there is a skill with regards to creating portfolios. For example, how you define the value factor, and there are better and worse versions of that. So, for example, if you think about a classic way to define value stocks would be via price to book, but you can argue the price to book ratio for some of those technology companies is almost irrelevant. So from that perspective, in terms of how you create factors, which assumptions do you put in, what transaction costs you assume, these all play a role. And I think you can create a better version of a factor as well as a worse version. Having said that, the fascinating part about this is that even though there are differences, so for example, if we look at value price to book versus EV/EBITDA or like a multi-metric approach, the trend in factors tends to be the same, unless it's of course creating very extraordinary, very unusual metrics, right? So that's the part that we find most interesting about factor investing in general, that it doesn't really matter if you create factors sector neutral, if you look at them within a country, cross-sector basis, if you look at it country versus country, US versus Europe, even if you look at them across asset classes. So for example, if you look at like value in commodities or fixed income or in equities, often you have the same trends. And this is actually an area of research that from our perspective is a little bit under-researched in the sense that there's not enough out there. What is ultimately driving the factor performance? And because you see the same trends, for example, if you look at China, which has been a market from a stock perspective that has been walled off for a long time, in the sense that it wasn't very easy for an institutional investor to trade Chinese stocks. Factor investing there, from a pure trend perspective, in terms of looking at, for example, momentum in China versus momentum globally, it's still the same shape of the curve. And so it's fascinating to ask, why is that? Why are Chinese retail investors almost behaving the same as investors in Europe? And so there seem to be these drivers beneath factors, which are ultimately macro drivers that are responsible for most of the returns of these factors. And So there is skill with regards to, going back to your original question, there is skill with regards to creating factors, but it's limited to a degree. So for example, if you think about value investing, which has not performed so strongly the last 10 years, could you have created a value strategy that was slightly better than the average? Yes, you could have, but it would have been totally different. No, it wouldn't.
Understood. So you're the founder of FactorResearch. Could you tell us a bit about the background? How did you get started into this?
Sure. So from a career perspective, I started working in investment banking at Citigroup. Did 2 years in London and 1 year in New York. Then moved across to a sovereign wealth fund at GIC, which is the government of Singapore Investment Corporation, and invested in real estate in terms of real estate stocks, real estate debt, and also real estate buildings like private equity. So had a fundamental way in terms of being educated initially in the sense of building fundamental models while being an investment banker at Citigroup, while also being a fundamental investor at GIC, but didn't really find that fundamental way of investing was a philosophy that I could share, simply because if you look at the industry that I was working in, it's very much driven by macro factors. So if you build a model, for example, for a hotel, effectively it's all about how is the economy doing. If you think about rent, for example, for a hotel in terms of discounting that back, that requires interest rates. So in fact, the entire real estate industry is based on doing macro assumptions. And when I look at the success of being able to forecast these macro variables, it's very low. Most economists are not particularly good at forecasting what the economy is doing. And so despite being educated by Citigroup and GIC fundamentally, I thought a quantitative approach was much more interesting. Effectively, then I quit and set up my first entrepreneurial venture, which was a hedge fund called Jackdaw Capital that was focused on real estate stocks. So I stayed in the same universe of companies or industry, but took a very quantitative approach to it. So did pretty much the inverse of the way I was taught how to build models. And so I was running a quantitative strategy at my hedge fund for a number of years, specifically a statistical arbitrage, which effectively is like a pair trading strategy. And that's also where I came across factors. And running a hedge fund also, of course, educates you in terms of how the hedge fund industry operates, in terms of what kind of strategies are out there, in terms of what other managers are doing. And by going that way, effectively, I learned factor investing and also discovered that most alpha from hedge funds or exit returns generated by long-only fund managers are explained by systematic strategies like factors. And effectively, that gave the birth to FactorResearch, where initially we had a different business plan than where we are today. So the original idea was quite simple, is replicate hedge fund strategies with ETFs. And simply because most hedge funds aren't doing anything special, they're simply offering factor exposure one way or the other. And although the idea still has merit, as an entrepreneur, you can work hard, you need to be smart, but you also need luck. And if you look at factor investing over the last few years, in terms of those classic traditional factors like a value, like a size, none of them has performed very strongly. Our original idea in terms of to launch ETFs that use factors as components simply didn't make sense. So you have to wait a little bit and wait until the market turns. And if you look at that from some of those large asset managers that focus on factor investing, either from a long-only or long-short perspective, they just seen dramatic declines in AUM because investors have a little bit cooled off from factor investing, at least from classic factors like the value and the size and so on, because they haven't performed very strongly. And during that journey, effectively, we, from a firm perspective, learned that most investors are still unfamiliar or at least not too knowledgeable what's actually driving their portfolios. And that effectively gave to the application that we launched a few weeks ago and where we are today from a perspective.
All right, so can you tell us a bit about that? And I see on your website 3 different options. I can go for a portfolio diagnostic or a model portfolio search or security analysis. How are people using that?
Sure. So what we effectively do is we simply help investors to analyze their portfolios and also find better ones. And so we've been doing that for a number of years and realized that most investors, despite of course knowing what they hold in their portfolios in terms of the securities that are there, that often they still don't know what's actually driving it, especially from a factor perspective. And it doesn't matter if you think about a sophisticated retail investor, if you think about a financial advisor that is looking at client portfolios, or if you think about institutional investors. There's still an awful lot of intransparency when it comes to what's actually driving a portfolio. And so we've been effectively doing that as a service for a number of years. And we learned that there's a much greater demand for that and effectively created a product out of that. And so we launched this platform a few weeks ago that effectively allows anyone to analyze their portfolios, see what's driving it, for example, from a factor perspective, what's the ESG score, also things like expected return. And there's a lot of financial engineering behind that effectively brings transparency to investors and not only analyze what's in it, but also what might be better. Because unfortunately, most investors are still overpaying for the portfolios they have. And there's no need for that. It's simply because they don't know better, they don't have the technology, and effectively build that for them. So what they can do is you can simply import a portfolio, and we often show you, hey, here's a similar portfolio that has the same risk exposure, but it's at a lower cost. And part of what we do is it's quite mission driven in the sense that we just think investment outcomes can be improved, and it's fine to talk about that, to create content about that, but it's much better if you empower investors with technology for them to effectively do that themselves and learn in terms of how they can ultimately improve the outcome for themselves or for their investors.
Yeah, that's a very interesting perspective. This could almost talk about it, the transfer of wealth from the investors to the investors from whoever was claiming or trying to create alpha, create outperformance, which in fact can be replicated, and technology is the vector that creates this way of replicating in a cheaper way, and therefore improving the outlook.
Yeah, correct. And look, this is not only a tool that we build from a commercial perspective. There are large-scale problems out there. So, for example, if you look at pension funds in the US, or even in Europe, they're 70% funded, right? And we can talk about that, but practically that means that pension payments need to be paid, need to be cut, right, over the next 30 years. And if you think about that from a global perspective, that's a massive issue, right? Because cutting anyone's pension payments is not a funny business. People will not like that when that happens. And you can already think ahead that this will create unsound political decisions because politicians will ultimately cave to pensioners that are protesting. And partially that is because there have been a lot of unsound investment decisions. For example, like pension funds investing too much into the same asset classes that on paper prove diversification, but not in reality. And of course, we're a very small part of the financial industry, but addressing that problem via technology is something that needs to be done because at the moment there is still too much intransparency about that. And for example, at the moment we mainly focus on equities and stocks and mutual funds, but you can make the same case, and we're working on that, on expanding our platform to also private asset classes. Like private example or real estate. Because on paper, again, most of that seems to be, for example, diversifying. But if you look at it from, for example, utility perspective, it's the same bet, more or less. Private equity is still equities, and there's this intransparency, and if you can address it with technology and with data, it will ultimately improve investment outcomes, which, as mentioned, are real problems, right, that should be addressed, and the sooner the better, because it affects all of us.
Yeah, understood. It's tough, from what you're saying, it's a bit tough on people who are, for asset managers or, let's say, traditional active managers. So let's talk a bit more about alpha. And you mentioned it was something unexplained in the market, and that potentially it was also something that was becoming harder and harder to find.
Yeah, correct. So if you look at alpha in general, as mentioned, from a pure data perspective, going back to the pyramid example, right, where you have market beta at the bottom, then you have factors and you have alpha on the top, right? That pyramid is becoming steeper and steeper, with alpha becoming less and less, simply because investors nowadays know that most of it is not true alpha, it's just exposure to something else, right, that can be replicated more cheaply. And as mentioned, then, even if you find a manager that has done something unique to create alpha, the challenge is to be able to do that again on a going forward basis. So what you see from a researcher perspective, often that there is no consistency in generating exit returns, and that applies across asset classes. So if you look at public equities, if you look at bonds, even if you look at private equity, for example, there used to be consistency in terms of creating exit returns if you look at large LBO firms. But if you look at the most recent studies, the only place where you still find consistency with regards to generating exit returns, outperformance, is actually venture capital. And the reason for that is quite simple, because if you think about public equities, it's very difficult for a fund manager at JP Morgan to have a competitive edge over someone at Goldman Sachs. Because they have the same data, Bloomberg terminal. How are they supposed to create outperformance? They have the same access to management and so on. Now, And unfortunately, the same applies to fixed income manager. It does nowadays also apply to the private equity industry because there's so much money nowadays in private equity that the difference between, let's say, someone is selling a company, going to a CVC or a Blackstone, it's more or less large pools of capital, and there's 10 other private companies you can talk to. So the information asymmetries have largely been arbitraged away. And with venture capital, the difference is that this is very network driven. So effectively, you have a very small amount of people, most of them are sitting in Silicon Valley, that effectively draw the attention of most founders. So they have effectively access to better deals because it's not as regulated and it's very personal driven, right? So for example, as a founder of a company, you would love to go to that venture capitalist which has created companies before, which has brought companies to the market, and who has also become very wealthy through that process, right? Who you look up to. And so that venture capitalist, he does get deals which are private, which no one else sees, and effectively can create, outperformance or alpha through that. But it's unfortunately one of the few niches within the capital market that is still attractive in a sense of, where alpha can be generated.
Yeah, that's a very interesting perspective about venture capital. In fact, there is information asymmetry, so not everybody has the same information. And then as well, it's not the same. If I invest in General Motors, it doesn't matter if it's me or if it's Bill Gates. Whereas if it's a startup, the person matters a lot, and therefore you could see alpha there. I hadn't heard that before, but that changed my perspective on venture capitalism. And if I go further, so we're saying this alpha is in public market, it's getting harder and harder to find. Could we take an example? And you've published something on merger arbitrage. And I would have thought that on a merger arbitrage, there's really, which is benefiting from the difference in price between the target price and the current price. You would think that there's really some skills involved, but this is also disrupting. But could you explain a little bit more, and we'll put the link to the article?
Correct. So merger arbitrage is a classic hedge fund strategy. Where effectively you do exactly what you outlined, right? You buy the company that is about to be acquired, and you short the company that is acquiring it. And this is actually a strategy that is well researched. It has been run for a very long time, and it's also backed by academic research. And so from our perspective, that's fantastic if you think about kind of alternative strategies in the sense of, having a long track record and being supported by research, having an economic rationale why it should exist. So that already checks a lot of boxes. And if you think about the rationale is that there's always uncertainty if a deal will close. And effectively, if you bet that the deal will close, what simply history shows is that there's a little bit of uncompensated risk, and effectively that's the alpha you can extract from merger arbitrage. So that's all good. What's also good about the strategy that it's constructed market neutral, right? So effectively because you're long and short at the same time, right? You can construct it beta neutral if you want to make it even cleaner. So it is what is great in terms of being able to diversify a classic portfolio in terms of having exposure to merger arbitrage. Now, the two problems with the strategy is, on the one hand, is there's simply too many folks pursuing the strategy. And if you think about it, then effectively, if there's too much capital chasing one strategy, effectively the spread between those two companies, it just decreases over time. So that's the one issue. The second issue is that what you ultimately want, if you look at alternative strategies or hedge fund strategies, and merger arbitrage belongs to those two categories, is it should be uncorrelated to traditional asset classes and specifically to stocks. Now, unfortunately, in the case of merger arbitrage, and we highlighted in that research piece, that is not the case, simply because you can see that in 2020, during the beginning of the COVID crisis, when effectively the mergers did not close, so that spread became a lot larger, and effectively when you as an investor, having invested in merger arbitrage, you thought this would be a market neutral strategy that behaves uncorrelated to the rest of your portfolio and provides protection when you most need it during a crisis, that it failed to offer that. So that is a little bit the issue in terms of merger arbitrage, that it does diversify in the good times when practically speaking no one needs it, but it fails to provide diversification benefits when it's most needed. It is backed by academic research, and there's a good reason for why there's a spread. From our perspective, it's not really attractive to diversify portfolios because what you want is something that's uncorrelated, that has positive returns, but also uncorrelated when you need it most, and that's during the crisis period.
And if I go back, for example, to your Factor Olympics, and I see value being not only the worst performing, but also very negative. How would you say sophisticated investors can use factors?
I think for most investors, factor investing is almost irrelevant. Having said that, if you are, let's say, a pension fund and you manage your own portfolio, and you, which some of the large ones do, they have large teams and so on, they have all data, they don't need to outsource that, and you do want to generate excess returns, for example, like above the S&P 500 or the FTSE 100, then factor investing is the best bet you have, simply because it is backed by research, right, that over time, this allows you to generate outperformance. And so what you can do in terms of simply use factor investing to construct your portfolio based on US stocks or UK stocks, look at the academic factors, right, and either tilt your portfolio to a specific factor or to several factors and try to harvest those premium over time and generate excess returns. So I think that's like the only kind of like safe is the wrong word, but the only way to generate outperformance on a consistent basis. Having said that, I should mark, disclaim that consistent means that even then, for example, if you think about a multi-factor model where you combine certain factors to decrease the risk that one factor has a large drawdown, like value, for example, which declined pretty much each year over the last 10 years, even there is no guarantee that this does create positive X returns on an annual basis. And so factors are as cyclical as equity markets, so they perhaps move different to equity markets, but effectively they still need a medium to long-term horizon from an investment perspective, right? Institutional investors that commit to factor investing, they should still have expectation that despite using the best factor model and combining factors, there still will be years where it does not work. For example, the last few years where none of the classic factors worked. If you combine value, momentum, and size, for example, or throw in quality or low volatility, nothing worked particularly well over the last few years. And so you have those patches. There's nothing unusual about that. You also see that if you go back in time, and you can use the data from Professor French and so on to go back 90 years, you can see that even multi-factor investing has periods where it underperforms and generates negative X returns. But as long as you know that, you accept it, you have the fiduciary possibility of weathering these down years effectively, then long-term, it's unfortunately the only bet to generate X returns in public markets.
So if I sum it up, if I'm a non-sophisticated retailer or just not enough sophisticated investor, it's probably not worth it, not for me. If I'm a sophisticated investor, like you said, it's the tool that I have, and therefore I should try to leverage it. But then there's also a third way, it's to at least use it to not pay for fees for alpha that is in fact not really existing. And that's a very concrete action that I can take. And that's when, for example, I could use the tools that you have there to get started.
That's a little bit more from an analytical perspective, but in fact investing, it creates transparency. And so from that perspective, it's fantastic, right? And even if you don't pursue factor investing yourself, it often shows you what a fund manager is doing. Either, for example, he has exposure to a certain factor because it's his style, because he likes buying cheap stocks, or if he changes his style over time. And so you can use it from an analytical perspective. And it's great in terms of empowering investors to a little bit see what is going under the hood.
That's a very nuanced and I think a very interesting approach about this word of, it's not just about factor investing, eventually it's about investing in general. So thank you so much, Nicolas. Maybe a last question about your outlook on the industry. How do you see this going and what are you excited about?
So overall, it's probably a little bit a depressing outlook because if you look at what all we discussed, it effectively means that active management will become more challenging. If you look at it from a AUM perspective, for example, in the US, about half of what is in passive by now. I think these trends you will also see in Europe and in Asia over time. So effectively, that would lead to a consolidation of the industry simply because fees are coming down. And that, if you, let's say, you just finished your Master of Finance in university and you're thinking about financial services and industry perspective, there are certain pockets that are becoming less attractive. Having said that, I think that's overall also good, because I think a lot of what the financial services industry is doing is rent seeking. It's effectively a transfer welfare from normal people, right, who do not understand what they're investing in, to people working in Wall Street and City. And that effectively is where fintechs, for example, are quite interesting, right, in terms of generating transparency. And I think that's fantastic in terms of outlook that going forward there will be more transparency that ultimately will improve our lives in the sense of having more savings when we retire, actually better returns. because broadly speaking, the world where we are today, from a pure financial perspective, from a return perspective, is a challenging one. So if you look at it from a valuation perspective, valuations, for example, in the US are sky high, right? And often that means lower expected returns. Now I think about it from a debt perspective, right? Global debt is at a record high. That tends to lower economic growth. And then you think about things like demographics. That's truly terrible. So you look at China, which is losing 400 million people over the next 80 years, right? Which cannot be pretty no matter how you spin that. So overall, being an investor will become more challenging. And I think the more tools we have, the better data we have, I think ultimately it will all help us to achieve better investment outcomes. And technology, in terms of from a fintech perspective, will help with regards to that.
It's a great conclusion. That's also what makes me so excited about fintech. If it's about lowering the fees in our investments or lowering the cost of payments with what's happening in fintechs, and therefore, again, transferring the wealth to regular people rather than all intermediaries. I think that's a very positive outlook. Thank you very much for this masterclass on alpha and factor investing and this perspective on the investment world, Nicolas.